Welcome to Cal Talks. This is Marcelo Wallau, Forage Extension Specialist with the University of Florida. And this is our podcast, where we dive into the main topics affecting livestock and forage production in the southeastern United States. Join us in this journey as we tackle the main issues affecting our producers and the sustainability of our production systems. Welcome back to Cal Talks. I'm Marcelo Wallau, Forage Extension Specialist and Associate Program Leader for the University of Florida, and we're here to talk about taxes. My guest today is Tom Bryant. He's a CPA with Beasley & Bryant. He's a public accountant and a rancher, but more importantly, he's an active member of the Florida Cattlemen Association, is chairman of the membership, and also of the National Cattlemen Beef Association, NCBA. He's a vice chair for taxes and credit and has a lot of experience. Tom was telling me here that he has been writing articles for the Cattleman magazine for over 20 years on taxation. Tom, welcome.
Glad to be here.
Tom, we're in the middle of tax season, and I have air quotes here when I'm thinking about tax season because people only think about taxes for that April 15 deadline. What's your take on that approach? Taxes is just filling them sometime in March so you can submit the paperwork in April.
That's a good question because normally the focus on the April 15th date, but that's really, if you get past the end of the tax year, which is December 31, you do your tax planning before December 31. If you wait, you cannot do very little tax planning from December 31 till you file a date on April 15th. You're already too late. You know, it's the question, do you buy equipment? Do you buy cattle? Do you sell something? Do you move your income from one year to another year to maximize income and expenses? You prepay for some input costs like fertilizer, feeds, and that type of thing. So your tax planning really needs to be done throughout the year. April 15th is just when you have to file the paperwork, the compliance side.
So pretty much if you wait until now to define your tax plan, it's too late. So for those listening, we're not talking about the 2025 filing. We're talking about planning for the next year.
That's exactly right.
So Tom, I grew up with that idea that tax planning is something that we do year round because tax planning can be the difference between making a profit or not at the end of the year. In your opinion, what is the main issues that you see in terms of taxes that a lot of the ranchers get in trouble with because they don't plan their taxes?
Ranchers, they operate off the nature. They look at the calf crop, but that's the end product is what they're trying to market. What you really need to focus on is what you have to spend to get there. And really, when I talk about timing of buying of equipment or leasing equipment or doing major pasture renovations, you can stack and move your income to maximize your tax impact on your business scenario. And let's face it, there's another issue. The white elephant in the room is going to be the hobby loss rules. If you continually have other sources of income and have these losses that keep on accumulating, that can be a trap that will catch you in case you get examined or get questioned by the IRS. And you got to think about who really utilizes the tax information. Your bankers want to see some profit. Your tax return, well, you can play with that with a toolbox that's available to a preparers on working in the tax returns. So you have a lot of opportunities, but it really takes business planning. You have to be focused on the business. Let's face it, farming is a business.
You bet. And I think a lot of people don't face it as a business, especially because they are not living off of farming. Most times they have secondary income. And that takes me to one of the articles you wrote. You highlighted that 80% of our ranchers are operating in limited area with probably less than 50 head. And that gets them pretty close to that hobby because most of them are not able to really survive only from the cattle business.
That is a very important note. So that simply means they have a major second source of income or a primary source of income. Cattle happens to be maybe a quality of life issue or a way of life issue, or they live on a legacy type farm situation. So those are the cases that hobby losses really are attractive because usually people will buy cows, equipment, and use the losses from those to reduce their other sources of income, which is non-farm income. It's kind of surprising that 80%, and this is nationwide, 80% has less than 49 cows. That tells you that the large ranches or the people that have more than a couple hundred cows are the rare issue versus the populous farmers have a small cattle operation. So that allows you to make some plans and maneuver around your tax side.
I think for a lot of our livestock industry, we see that with the small ruminants also. You have a large amount of small farmers and also a growing number of heads of inventory in the large farms. And then that middle part is just dissolving. And there's a couple of things that are happening. First of all, there is distribution of farmland. So families go on and the new generation splits the land, and many of them are just not able to survive in that smaller piece of land. So they either need to get out of business, sell to someone, or they're going to reduce the herds, get off farm income and be able to survive. I want to unpack this aspect of the hobby farming because, as I said, it probably affects our beef cattle producers here. What is this hobby loss, and what are the important things to consider about what should we be concerned about?
Hobby loss is nothing more than where you need to run the farm like a business. When hobby loss gets invoked is when you do have losses. But the IRS has imposed a test of 8 items in the hobby loss arena. And basically the losses is dictated on how you run the farm. First of all, you need to have a business plan. Okay. In the business plan would include budgets, include your break-even points. If you have, out of a 5-year time period, if you have 3 profitable years and 2 lost years, then your hobby is not going to be raised. But if you have 5 years of losses, then a hobby loss very well could be raised. And once the IRS raises the hobby loss issue, then you have to go on the defensive and you have to prove that you are truly in the business. Having a separate checking account, separate than your personal account, having an LLC where you're having entity set up to run the cattle operation through it, then you need to be sure that you document a time that you spend on the farm. There's a perception out there you get material participation if you have 500 hours a year devoted to your farming activities. In my case, my wife feeds our animals every day of the week, and that takes her about 2 to 3 hours every day to feed. So we kind of work towards that issue of meeting the 500 hours that you can document. Now, the crucial thing about the time period, you have an investor view, which somebody that looks at the financial performance of the accounting records, so the hobby operation or the farming operation, versus actually physically doing the work. 500 hours is physically doing the work.
Okay,
not paperwork, not pushing a piece of paper around sitting in your cushy office.
So pretty much being active there.
Yes,
in the farm,
they want that sweat equity. They want it there. Then the other thing is, do you have the expertise to be in the farming business? If you have a doctor or a lawyer that wants to be a farmer because he likes living on acreage, do they have the expertise? No. You need to surround yourself with people like with IFAS, your county agents, use outside consultants, or somebody like yourself. Just issue a memo to them. That becomes part of the expert side.
So important thing, just a call out for extension here. So we can help you to prove that you are indeed trying to improve your skills by interacting with extension. So,
and keep a calendar, document those visits, and keep notes from those visits too. That's part of the expertise associated with that. Then the other one thing is too, is that do you have other business ventures that you've done when you have other sources, other business ventures? Were you successful in those? Or are you one of these people that always loses money, whatever they pursue? Then that goes against you, because then that proves that the cattle operation is a loss, which is a mechanism to reduce your tax liability. And then you have to have a history of your cattle operation. This is where you have to have the accounting records to compare back against the budgets and have you made money or you lost money. Now, the IRS will give you a little bit of leeway as far as the depreciation expense, because that's not necessarily an add back to where you made money, but you need to make money cash flow.
So there's a difference between making money cash flow wise and making money having a positive balance at the end of the year, right?
That is correct.
We need to show that there are those transactions of sale, that you're indeed active. But sometimes you're not going to have that end of the year profit.
Yes, that's exactly right.
So when we look into agriculture today, especially on the row crop side, cattle prices are fantastic today, better than they've been in a long time. It hasn't been like this forever. We used to be hard times not too long ago. Cotton, corn, soybeans and peanut today, people are losing anywhere between $40 and $400 an acre based on some of the estimates that we have. So there is intent, they're producing, but you just cannot make the money because the market is complicated, and into those 2 out of 5 years, or three, you need to show profit 3 out of 5, you're probably not there. How do you operate in that scenario?
Well, there's a recent case that came out a couple months ago that the tax court ruled in favor of the taxpayer's argument. There was hurricanes, there was drought, and then there was COVID. And those three major non-business related issues did prove that he was losing money. There was no way in the world he could make money during those time periods due to those extenuating factors. So it kind of does get back to the natural occurrences outside your control. But normally you need to focus on the fact, is this a profitable business or not? And can you move forward? And the important thing too, Marcelo, that I want to say is that you need to listen to your experts. You need to change your market conditions. If you historically sell all your weaned calves at the market versus going directly on Superior or selling them to another producer direct, that's a business model decision. And if you need to figure out where your niche is and how you can make money.
So basically, tax planning here, we're not only talking about filing the taxes again, it's really about that business plan, that broad picture business plan.
It is about the business model. It's called you're filing tax returns stating you are a business. You have to walk like a duck and quack like a duck, and you need to be a duck. You need to be the real thing. Just to have it and look at cows in the pasture is a nice aesthetic, but that's not a business.
Correct. So for those folks that just think I'm too small to bother with this, what do you have to say to them?
Well, I think you need to look at the facts and circumstances. Are they in it to make money, or they just want to have 10 cows to look at? Okay. And there's a big difference. I will tell you, having 49 cows is not really a hobby. It takes a business element to it. But I've had people that have 10, 20 cows, and they like to look at them every day. The wife likes to go out there and see how pretty the cows are, but that is not a business model. So you need to really focus on the economics. Now, I have some people with 49 cows that are making money at it, but they run lean and mean, and they're out there. So I have people that make money with a couple thousand cows. So it all depends if you know how to run a business.
I want to change gears a little bit and talk about something that probably many of our listeners are interested on right now. And this is related to specifically to this tax season. There are a lot of changes that came with the One Big Beautiful Bill Act, OBBA. What are the major things that change now that our farmers need to be aware of as they're filing their tax this year?
That is a great question. And the OBBBA just made some items that was passed permanent, like the bonus depreciation, like the code section 179 bonus, is that you now can go up to 100% of the equipment that you bought. They basically threw in some things on the QBI, qualified business income, where you get that 20% reduction of your profit that you don't have to pay tax on from the business side, and that's really based upon wages that you pay. That kind of help equalize the difference between a person filing as a C Corp, which is taxed at the C Corp rate, versus non-corporate tax rate is really at basically a 21% effective tax rate. So that's at the big corporation level. So they kind of threw some benefit in, made that benefit better for them. Also, was an enhancement basically to the NOL, net operating loss carryforwards. Farmers have a unique respect inside the tax code of being able to carry some losses back versus carrying losses forward. That was made permanent in the OBBBA. And also, there was an enhancement basically to the Schedule J, something that a lot of farmers do not understand, that Schedule J is income averaging for farmers. That used to be a long time ago, 20 years ago, called Schedule G income averaging. But Schedule J, if you stack your farming income, say sell 2 crops of calves in 1 year and have a large income, and then you have losses on the front on both sides of those years, you take the 3 prior years effective tax rate, apply it to your current year's rate, and that can be beneficial. We're talking about the difference between 21 and 35%,
which is huge here.
Yeah,
right?
It's a huge number. But you got to have tax planning. You got to have the records. You got to know what you're doing. And it's called stacking income. We in the tax world have a toolbox of things that we can use. We have the flexibility, like on bonus depreciation. Do we want to take bonus depreciation on a certain class of assets and not the other class of assets? These are all things that the OBBBA made permanent for us to work with. Previously, the OBBA had phased down the bonuses down. And basically, it was going to be 40% last year, 20% this year. That's now 100%. So if you go out and buy cows, breeding cows, you can write them off, but you need to have some income. And there's some other things that you can do there too. And the biggest thing for farmers probably that the NCBA was pushing was really the death tax issue, where they raised the unified credit up to $15 million. Basically, this simply means that if you pass, you can have up to $15 million of assets in your name that you can pass to your heirs and not have any estate income tax.
I've seen too many, way too many, and some even close to home, people that have not had planned the succession. And what ended up happening, they have to sell part of the farm to be able to pay those taxes because they did not plan that succession well. So this is a very, very important part of this whole business plan as you have been proposing here.
Yes, that is extremely important. Now, I want to say that 15 million is per person. So if you have a husband and wife, they got 30 million. So the thing about it, if the wife passes first, let her distributions go down to the siblings, or for the succession planning, pass it down. Then that way you still preserve the surviving spouse 15 million. So this is kind of like gives you 30 million playbook.
Yeah, no, that's big. Tax succession planning is something that most people don't talk about. They don't understand. They don't like to talk about because maybe you're already eyeing my inheritance and that's all it is. But it's super important because if we're talking about a business, that could be a lot of loss. So we talked about the depreciation. We talk about the QBI and the Schedule J. How can the farmers identify those tools that would be more beneficial for them?
Well, this is where you have to have your financial records of the farm. You have to know where your income centers around. You have to know where you're selling calf sales. Calf sales is considered ordinary income. When you sell mature cows or breeding stock cows, if you hold them for more than 24 months, then that's considered long-term capital gains property, which simply means that's if you sell them in the form of a Schedule C, that means it's outside of being taxed as Social Security self-employment tax. But there are mechanisms that you can, how you treat things and how you want to move things around on when you buy these assets, how you want to depreciate them. And once they're there, if you do depreciate them, then you got to have the capital equipment, what we refer to as a depreciation schedule, which tells us how long we have to write those animals off. You have elections that you make in the year of purchase, where you make the election whether you want to expense it or whether you want to depreciate it, which impacts where you're going as a business entity on how you want to pick and choose which way you want to go. So if you're selling timber, you got timber coming in a year or two, then that's one thing. Or if you got to repair your squeeze chute or rebuild your fences, then that's going to be an expense. You got to budget for that. And these are all part of the business considerations that you got to know where you've been and you got to know where you're going. And you got to have the records to prove it.
That is fantastic. And tell me something, this is part of the work that your company and other companies do in terms of tax planning, or this is normally beyond what the traditional CPA would be able to help with?
If I am doing my job right, we will already know by the majority of our larger farmers or people that want to know what their tax liability is going to be before the end of December or before the end of November. And they can have the month of December to plan things around. So this is all part of doing things around the year to get to that end result. So yes, this is something that a person knowledgeable in the ag world and how you can treat them. If you go to a preparer who doesn't really know anything about ag, they're going to be very narrow focused on money coming in, money going out, and they don't know how to handle it.
And you are losing a lot of opportunity there to make a profit or reduce your taxable income.
Worse yet, you could be opening yourself up to the hobby loss question too.
No, that hobby loss is something that I think touches a lot of our listeners. Again, 80% are operating in small herds, and they really need to be aware of that. You mentioned hobby losses again and excessive losses. What are the main red flags that you see?
It really goes back to the taxpayer. What is the taxpayer's business history?
Okay.
And you got to look at him. If he's a professional having farm property, then that's a completely different set than somebody who's a full-time farmer. And I'm not worried about hobby losses on a full-time farmer because they're out there. So it becomes a pure business issue. That's the other 20% of the people. So where you're going in that scenario and trying to size up how you want to get there. And I stress that how you get there is really takes communication. You got to sit down and talk about it. The tax preparer needs to understand his client and what the client wants and where the client's going. And you got to look at the succession planning. Are you stacking things up to something to give down, pass through? Are you going to sell out? Or are you going to have one of your 3 kids that's going to take over the farm? You got to deal with the other 2 that live off the farm.
So everything ties in together pretty well here.
It's a tight circle. And the circle is getting tighter with the increased value of Florida land because the options are getting a lot more in favor of the people selling out versus let's face it, farming's hard work.
Oh yeah.
And people don't want to work that hard to a degree. But I have some farmers that it's a real deal on the family farm. They are out there and they're good. And it's a pleasure to see them and visit with them.
Oh, it is great. And also we work with a lot of those and again, many of them are living off farm income, but that doesn't mean they are not dedicated to that farm as well.
I will say that the Florida Rural Family Land Act has kind of helped preserve the family farm to a degree because it takes the development issue off the table. And the successful operators have taken that money and bought more equipment. They made their farm better. And some of them have bought out the other retiring members of the family that did not want to become in farming, which is unfortunate, but it has preserved the legacy of the agricultural operations.
And that same with some of the easements and all that. Did I hear something? There were some changes in terms of the easements and related to the OBBA?
Not as far as what the Florida program is, not really. That is really more at the NRCS and the USDA level. There's some easement contributions. They did strengthen it from the perspective of larger operations, but I really don't see a lot of that type of easements taking place in Florida.
So you brought in NRCS. There is also another aspect of the bill that changed a little bit to help the farmers, which is related to both insurances and cost share programs or subsidies, right?
Yes. It is the definition of what's a farmer, whether you can be an LLC or how many members of the farm. There's a form in the application process called a 941. It kind of helped define where's the income at. That's where if you break a 900,000 gross income, that's just where it's part of the qualification. They're giving a better definition. The penalty there was when you have multi people that own a farm and only one of the people is operating the farm, then the other got penalized, how much they could receive from the insurances.
Interesting. Well, again, it makes it a little more straightforward for our farmers to operate.
Yes, it does. It does open up the door for better coverage. That program is getting better.
This is very important, especially when you think about also insurances, because as we experienced here, we went through 2 very strong years of hurricanes into a year of extreme drought and cold weather that resulted in a lot of agricultural losses all across the board. So I think those changes in the insurance side, it's going to be very important to consider in the future.
Yeah, I think they're going to have a great year on selling drought insurance for next year.
Yes, I think so too. And so the pasture insurance has already passed, right? But for some other crops, including for pecans, they're still out there. So keep an eye on those. I want to wrap up our conversation here with a scenario. Assuming we really are not too worried about we're not too worried about the taxation part and tax planning and a business plan and all that. They listen to us and say, okay, I think I need to be paying attention to this a little closer. I think I need to do a better job here. How would you guide someone now this year? We're recording this mid-March, so we have still good part of the year, have 3/4 of the year to go, plenty of room to plan. So we can start doing our homework and be better for next year and then for years to come. How would we start in this scenario?
I would take the business environment itself and say, look at your base of income. How do you make your money? And basically what I tell my cattle people is you better reinvest back in your genetics. You better reinvest back in your facility. You got to have where you can operate more efficiently. You can't be dealing with equipment that breaks down all the time. You got to have reliable equipment. You have to be more efficient with less labor, and you have to be smarter on how you spend your dollars on pasture renovation, the chemical costs. And I really say this gets a little bit back to IFAS. You need to listen to your IFAS agent on when you need to spray, when you need to fertilize, and you just need to up your game on being a better business partner. But you have to know where you've been, and you have to plot out where you're going. The goal here is to make money, to be sure you can always expand the market on that what you're selling, and then you need to determine where's your niche market, who you're selling to, and how you're marketing your product. There's a lot of opportunities out there that you need to look around. There's a lot of ways you can improve your operation. And then the caveat to that, you got to figure out, what am I doing this for? Is this something that I'm going to give to my kids? I'm going to sell down the road? What about the succession planning? And you got to get the people that on the succession planning, get them engaged, have a plan. So it really, I like to talk to people. The first questions I ask is, where are you going to be 5 years from now? Where you want to be 10 years from now? And that really, they stumble on that. The good ones will tell you. The ones that haven't thought about it will say, well, let me think about that. They're the one that need the help.
Sure. Yeah, and I see a lot of that because many times we're kind of going day by day basis on farming because we don't know what to expect.
That's right.
But and there's this excuse, well, I work in an open environment, I don't control many things, but you have the control of the planning. You have ways to mitigate those extreme weathers, market changes, and many other things by planning better. And I think we have a pretty good scenario today to implement some of the long-term strategic planning. And you talked about reinvesting in the farm because we have record high cattle prices. Yeah. We have the potential to realize very good profits in our cattle prices. And we also need to be careful if we realize very large profits. I think that mentality of getting the money and just saving, putting it under the mattress or in a savings account for later use because you were afraid of next year. Well, I'm not sure that really works today in today's environment, because if you are not making that money make more money for you, you're losing money.
Exactly right. When they start buying new boats and airplanes and beach houses, there's the end in sight on those. It's a mindset issue. I like to deal with the purebred farmer. They're great. They know where they're going. They love the land. They're great stewards of the land. And they do grow a good product, and they're out there.
Fantastic. Tom, to wrap up, what is the last message you have here for our listeners as they absorb all this information we talked about? And we didn't even touch much into actual what the new bill is and the tax reporting is. We just gave some big directions on where we'd like to see this. So what message do you want to share with our listeners?
Well, I'm a bean counter. I'm a records guy. You got to have records to look at. You got to know where you've been. You got to document, and you got to have your break-even point, your key performance indicator. You got to establish, are you really chasing pounds per acre? Or are you looking at the carcass quality? You have to set the mark for yourself, and you have to set goals on where you want to go. And you can't be a mindless rudder out there not knowing how you're going to get there. And I really think it boils down to records. You have to be a student. You have to listen to what's going on. Seek the help of others out there. There's a lot of expertise out there. IFAS is a great resource. Take some seminars that they produce. You have to expand your knowledge base on where you're going. And you got to decide how you want to get there. So it's more planning than anything else.
And that we'll appreciate you mention IFAS many times a year, and we're here to help you. And I'm glad that we have this show also that can help some of the people. And as you said, you need to show that you're actively trying to do the business, and by engaging in this type of training, that means you have the right intentions towards that. Tom, thanks a lot so much. And for those listeners that want to know more about tax planning, keep an eye on the Cattleman Journal, the Florida Cattleman Journal, because every month you are going to see an article from Tom and his group there. They're very educational and very good, but also don't wait until April next year to view your taxes and do the planning. It needs to be done ahead of time, and now we have the chance to do it.
Thank you.
Tom, thanks so much. As always, we would like to hear from you. If you have any comments, ideas, or feedbacks, please reach out to us through forages@ifas.ufl.edu and leave us a comment. We'd like to hear more from you. Thank you so much, and see you on our next Cow Talks podcast show. This podcast was brought to you by the University of Florida Forage Team with technical support from the University of Florida College of Agriculture and Life Sciences Faculty Instructional Resource and Support Team. This episode was produced by Marcelo Wallau, Olivia Mowley, and Ashley Kanabrowski. We hope you have enjoyed this podcast. If you have any comments or thoughts to share with us, please reach out to us through our email, forages@ifas.ufl.edu. uf.edu, and find us on our social media. uf.forages on Instagram, UF Forage Team on Facebook, or UF IFAS Forages on YouTube. We hope to see you in our next episode.